Hello and welcome to Stockwatch Live. Ian Conn, chief executive of British gas owner Centrica, is often pictured looking like a man with the weight of the world on his shoulders. But if he is in any way suffering, then he's not alone. Centrica shareholders share his pain. The shares in the company, which have more than halved in value over the past 4 years, are still trading around 40% lower than when he took over 3 years ago. And then, of course, there was also that 30% dividend cut. Staff too have felt the pain after an efficiency programme to save £1.25 billion a year signalled that 9,500 jobs will go by 2020, most of them in the UK. Now, Conn said it wouldn't be an easy task to overhaul British Gas and make it more competitive, more efficient and keep it in step with changes sweeping the industry. But unforeseen problems have continually nibbled away at investors' confidence in management. Trouble at its North American business division last November prompted a profit warning and sparked concerns of another dividend cut. And an equity placing with institutional investors in May 2016 to raise £700 million was launched with hardly any warning, so to say Centrica investors are unhappy is an understatement. Closer to home, its British gas business, the largest of the big 6 suppliers in the UK, has continued to lose customers to new market entrants offering cheaper deals. Another 110,000 went in the first 4 months of this year alone. Now, government pressure to end rip-off bills for households has led to a proposed cap on the industry's most common tariff, the standard variable tariff, which will squeeze margins even further. Centrica is now in better financial shape, having paid off half its net debt, delivered 3 years early on a promise to cut costs by £750 million a year, and made a pledge not to reduce the dividend further. While he admits the journey so far has been challenging, Mr. Conn remains undeterred. The strategy, he said, is right for us. At the half-year results on Tuesday, investors will certainly want reassurance and proof that he too is right. Broker Berenberg has just reiterated its buy recommendation, but cut its price target from 240 to 170 pence. Also on Tuesday are half-year results from Greggs. Back at the full-year stage, the baker-turned-healthy eating-cum-food-on-the-go company reported a slight dip in like-for-like sales in the year to the end of December. Then, talk of a challenging consumer environment was largely discounted by brokers who follow the stock. However, a warning that it is now cautious about the outlook for full-year sales, given uncertainties over market footfall and a slower pace of sales in the first 18 weeks of the year, has prompted a raft of broker downgrades. Berenberg changed its recommendation on the shares from buy to hold, but left its target price at £14.50, while Peel Hunt downgraded its investment rating from hold to reduce and cut its price target from £12 to 950 pence. Investors in Just Eat will be hopeful for some positive nuggets when the company posts half-year results, also on Tuesday. The shares led the FTSE 100 fallers, down 8% in one day at the end of June, after reports that the company had sounded a note of caution and left shareholders feeling uneasy over a lack of guidance on the outlook for 2018. The takeaway ordering specialist gave no new guidance for 2018, but said investment levels in the coming years would remain elevated and margins were likely to flatline. News that key competitor Deliveroo is opening its platform to takeaways that deliver their own orders won't help. This is unfamiliar territory for shareholders in the online delivery platform, who are used to record growth, having seen a phenomenal year in 2017. At the start of March, Just Eat reported orders were up 26% for the year ended December, and revenue grew 45%, so we'll have to see whether that has continued or the appetite for Just Eat is starting to wane. Now, with schools out for summer, Merlin Entertainments, which runs the likes of Thorpe Park, Alton Towers and Legoland, will be heaving with kids looking for a fun day out. It's the peak season for the theme parks and leisure attractions operator, and investors will be hoping that this summer is better than the last one, when visitor numbers to its London attractions, which include Madame Tussauds and the London Dungeon, fell sharply in the wake of a spate of terror attacks. When we last heard from the group in May, it said it was still feeling the after effects of that, but that it was hopeful that footfall would recover over time. 2017 was undoubtedly a difficult year, in which like-for-like revenues fell as visitors stayed away from high-profile attractions in London after the fatal attack around the London Bridge area in June. As a result, Merlin shifted its strategy slightly by investing in building hotel rooms alongside its venues. So investors will be keen to hear whether that has paid off when Merlin posts half-year results on Thursday. Bad weather at the start of this year will also have taken its toll as snow kept visitors away, but with the summer heatwave we've had since, and reports of record numbers of tourists flocking to the UK, investors will be hopeful of an upturn in visitor numbers. Finally, on Friday it's the turn of William Hill to post half-year results. The World Cup will obviously get a mention because of its effect on turnover. British bookies were expected to take in an estimated £1.2 billion in bets on the World Cup, with an estimated £20 million bet on England's opening World Cup match against Tunisia alone. When England's run was cut short, that pleased investors though. Shares in the group rose immediately after the 2-1 defeat to Croatia, as worries of a hefty payout by the bookies vanished into thin air. Along with England's hopes, of course. What will also be on investors' minds will be the effect of the ruling to reduce the maximum stake on fixed odds betting terminals from £100 to just £2. In the first 4 months of the current financial year, around 70% of William Hill's total gaming machine net revenue was generated by stakes in excess of the proposed £2 threshold, and William Hill has estimated that the move will hit operating profits in his retail division by as much as £70 million. Well, that's all for me for this week. To find out more about the companies reporting in the week ahead, go to the Markets and Insights section on fidelity.co.uk. Thanks for watching.